Welcome back to a market update video here with 213 Strategic Partners. For those of you who don't know, my name is Braden Sourbeer. I'm a next-gen financial advisor here on the team. I'm also joined by senior financial advisors Kevin Wager and Tom Macaluso, as well as our chief investment officer, Jeremiah Reithmiller. I think we just kind of dive right into this, guys. I'm going to kick things off here with you, Jeremiah. Over the last couple weeks or so, we've seen a lot of client interest in things like commodities, gold, silver, copper. Just wanted to get your thoughts on commodities and how they can kind of fit into the portfolio. And if you could speak on that, Jeremiah, feel free.
Yeah, it's not surprising that we're getting more questions about it, and rightfully so. Last year, gold prices doubled, silver nearly tripled. Copper is another one that's been doing well, and could potentially continue to do well. I think all these could potentially continue to do well. The challenge that we have with commodities in the context of a larger portfolio and long-term investing is the volatility that they present and the uncertainty from a return perspective. I'll use gold as an example. Gold had a 10-year period where the return was zero. Is it worth taking the chance that an asset any asset in the portfolio, whether it's gold or a stock, it doesn't really matter. The chance that an asset returns zero over a 10-year period is really challenging to have in a portfolio. And then you combine that with behavior that is not necessarily consistent. Gold's another easy one because we have more trading history on that one that you can run modeling against. There's periods of time where it's very much correlated to the S&P 500. There's other periods of time where it's a great hedge against the S&P 500, and then it has a similar relationship with the bond market. So the lack of consistency in its behavior relative to other asset classes, along with the volatility, silver, I'll use an example more recently, has had some days where it's moved more than 10% in a day. Those in the broader equity market, 10% days are relatively rare. I remember those days during COVID, and we were talking about the markets in the morning. After a 10% day, the next day you go 10% the other direction. You're talking about the markets intraday, end of day, and there's no real direction. So that volatility experience in a portfolio is not typically a good one. I will say though, this is obviously turning into a long answer. We do have some commodities exposure because these types of assets, because of the volatility and because of short and long-term trends in them, just themselves as an asset, we use them or have exposure to them in our trend following strategy within our liquid alternatives portfolio. So while our exposure is minimal in that allocation, we do think that that's a way to potentially play commodities and more of a active trading approach within that sleeve.
I could just jump in there. Just a question for anybody, for those viewing out there who might just be wondering maybe why we've seen such a rise in certain commodities. Maybe just a couple high level views on why we've seen such a run up.
Yeah, so gold in particular, I think at the beginning of the year was more political uncertainty in the U.S. So you saw a trade into gold. Silver and more recently copper has gotten more attention. Silver specifically in the fourth quarter of last year around the AI trade and the need for that commodity in what's expected to be a potential AI boom. We don't think it could turn out to be a boom turns into a bubble. I don't think it's a complete bust at some point. But the expectations is that more of those commodities will be needed to support that growth in the AI space. So it's back to it's just demand and supply driven, basically, and is a 3 times value on silver. Is that the right price, or is that over bought? Or does it have room to run? It's very hard to gauge that because you're not basing it on any sort of fundamental earnings projections like you would a stock or credit worthiness like you would a bond. So that kind of gets back to the challenge of modeling that. The only thing you really model is the trend, and then back to using trend following strategies to approach that asset.
Thanks, JR. You mentioned briefly there towards the end, kind of the importance of earnings growth being a fundamental driver in a lot of valuations, something that we're not really seeing in commodities. However, on the equity side, we are seeing that right now as we are in the middle of earnings season. I wanted to shift gears and kind of pass things over to you, Kevin, to kind of just give a high-level overview of what we're seeing so far and kind of earnings and valuations in that regard.
Yeah, absolutely, Braden. And I know last video we kind of gave a preview, so I'll give a kind of a 60-second update here. So yeah, Q4, we're in the early innings. About 15% of companies have reported. The earnings story really continues to be the same, which is strong earnings and revenue surprises. Both metrics are about 75% of companies that have reported thus far. Earnings growth for Q4, it's coming in at 8.2, which is in line with expectations, and that's going to put the full calendar year of 25 at more than 12% earnings growth. So a lot of big names are actually reporting this week, so we'll be watching that closely. But I think more importantly is what earnings growth expectations are moving forward. So looking at the first two quarters, at least for 26, both low teens of earnings growth, and the full calendar year of 26 is about 15% earnings growth. So I think the big takeaway here is continued earnings growth is expected, and it supports markets moving higher, which is one of the fundamental reasons why, at least from the equities, we still continue to be, I'd say, cautiously optimistic that the fundamentals are still in a pretty good spot. That might have been more than 60 seconds. I apologize.
All good stuff, Kevin.
Tom, I want to shift gears over to you and bring you on here. We're starting to tap into a little bit of an equity discussion here. I just wanted to have you speak to what you're watching in the markets, maybe things outside of just the US and maybe some smaller companies. So what are your thoughts kind of looking at the markets overall as a whole right now?
Yeah, absolutely, Braden, and good to have you on one of these videos. The biggest trend so far in 2026 has just been the relative S&P 500 and its underperformance relative to some of the other indices out there. We've sounded like a broken record. The last 5 or 6 years has been a very pro-cyclical S&P 500, which of course is the large cap stock sector of the United States. And we've just been patiently waiting for some of the other parts of the market, like smaller and mid-sized companies, developed non-US countries, emerging markets. And for the last half of a decade, they have been underperforming the S&P 500. But at the start of 2026, we have seen a shift in leadership. It's very preliminary. We're not saying this is going to be part of a more sustained rally, but you are starting to see better performance from the Russell 2000, the ACWI ex-US. And this is all to say, hey, we're not going to sit here and say this is now we need to sell US large cap. Of course not. But the reason that clients partner with a team like ours is because we are monitoring our exposure and our diversification to those parts of the market outside of the US large cap segment. And so far this year, our investors have been rewarded for that.
Thanks for that insight there, Tom. Last but not least, I want to kick it over to you, Jeremiah. We recently did a rebalance within our portfolios across a large number of accounts. Just wanted to give our clients just a quick recap of all the changes that we made there in the modeling.
Yeah, so within our strategic allocation model, these trades have played well to the themes that Tom has mentioned. We've maintained our overweight to small and mid caps. We're a little bit earlier there. We did that positioning last year, but we continue to think, especially from a valuation standpoint, and Tom mentioned the diversion of the markets with the large caps and the mega caps even consistently driving the markets over the last couple of years, that the small and mid cap space is prime for a breakout here. We're starting to see that this year. The other rotation that we made, Tom mentioned the international markets, was a more of a tilt towards international with a little bit of a lean, I'll call it more value. Global listed infrastructure was the specific strategy that we used that has a bit more of a bias towards like utilities and the value type companies. Again, similar to what we've seen in the US with growth companies running pretty aggressively, that theme has played out also in the international markets. So our trade into international is to look for better valuations, and then potentially as a way to play an infrastructure build out and a bit of an AI trade as well, both in the US and internationally. One of the other things that we're watching is we haven't had a significant correction since April in the equity markets. So at some point, we know there's going to be a correction. We never know when. You never know exactly how the rotation is going to play out. We're starting to see some rotation and other asset classes outperforming that underperformed last year. That rotation could get dialed up in a correction potentially, or everything could potentially sell off. So we're still relatively conservatively positioned in our model portfolios, knowing that at some point it's very likely we're going to get some sort of 10-15% correction in the markets, because that's the natural way of the markets. So we're positioned for that, and we in that drawdown be looking to take advantage of some opportunities of stuff that maybe looks even cheaper at that point, especially with valuations. Kevin alluded to valuations. The S&P 500 are still high despite those earnings growth metrics getting hit so far.
So in other words, it might be counterintuitive, but taking measures right now while markets are good, knowing that at some point we're going to go through a tougher patch, and then potentially leaning into equities in a methodical way is what you're saying.
Yeah, I mean, at the bottom line sort of basic level is the saying is buy low, sell high. I would say add low, trim high. It's not the reverse of that where you're trimming and expectations of a correction. You don't trim high and then hope to buy low. The first active trade you're going to make in terms of trying to add incremental alpha is buying those dips and then trimming back to your targets when you get back to those highs.
Thanks, Jeremiah. Well, on behalf of Kevin, Tom, Jeremiah, and the rest of our team, I just wanted to thank you all for taking a moment to watch our market update video. Please feel free to reach out to us via email or phone call if you have any questions or want to provide any additional feedback. We will see you guys next week.